Hey everybody, welcome. My name is Graham Pruitt. I'm with Alcova Mortgage. I've been in the lending business for almost 15 years now, and I think there's a lot of things that we take for granted as loan officers that we just don't realize people don't understand. And so one of those things is debt to income ratio. So let's get into it. Let's look and see what debt to income ratio is all about. All right. So our presentation today is going to be real quick. It's not going to take but a couple minutes, but we're going to understand what debt to income ratio is. So unlocking the secrets of your debt to income ratio. Why is your debt to income ratio holds the key to your loan approval? It's a big deal. Okay. Debt to income ratio is one of the main things that we as lenders look at to figure out, do you qualify for the house that you're looking to buy? Now, there's a lot of things that go into it, but we're going to simplify it for you today. Okay. So let's take a look at what calculating your DTI looks like. So when I learned how to calculate DTI, thank goodness it doesn't take more than a third grade math skill. Okay. So adding and subtracting and a little bit of dividing. All right. So step one, left hand side of your piece of paper, write out all your recurring debt payments, such as auto loans, student loans, credit card minimum payments, personal loan minimum payments, child support or alimony if you have those. Okay. List out the minimum payments on all those loans on the left hand side. This says a mortgage. I'm assuming most of us do not have a mortgage. So just list out what your debt payments are on the left hand side. Right hand side, typical normal accounting. What is your pre-tax income from all sources? And we'll talk about all sources and why that's important here. So include your salary. So if you're make the math simple, if you're on $100,000 salary, put down, divide 100,000 divided by 12. That is your gross monthly income. Bonuses. If you get paid bonuses, we average the last 2 years of bonuses. Average your last 2 years. If it's going up, average that number. Okay. Take 2 years of bonuses, divide it by 24. Okay. If it's declining, take that declining number, the lower of the 2 years, and divide that by 12. That is your gross monthly income for commission and bonuses. Same commissions is the same thing. We average 2 years. Rental income's a little bit more difficult because there's a way we calculate that. So leave that out for now. Okay. And then any other consistent income. If you're a day trader and you've been making $10,000 for the last 2-3 years doing that, put that number in there as well. Okay. A formula. So what we're going to do and how we figure out our DTI is pretty simple. We take those total monthly debts that we had on the left hand side and we divide it by our gross monthly income, multiply it times 100. So simple math. If you have $1,000 in monthly payments for car and credit card and student loans, and you make $10,000 a month, right off the bat, your debt to income ratio is 10%. Okay. DTI ratios and the implications that it has. Okay, so let's talk about front end DTI. So this focuses on the housing payment only. So let's just say you have no debt, okay, and your mortgage payment is $4,000 a month. You make $10,000 a month. Your front end debt to income ratio is 40%. Back end debt ratio, we include what other monthly payments that you had on the left side of the paper. So if you have $1,000 in credit card and car and student loan payments, and your mortgage is going to be 4,000, you make $10,000 a year. That's a 50% debt to income ratio. Okay. In most cases, that's going to be a little bit high, but if you look down here, most lenders are looking for a debt to income ratio of 43% and below. That is a safe number. Now we can go to 50%. Just depends on what type of loan you're getting. If it's a jumbo loan, a lot of these jumbo lenders cap you at a 43% DTI. If you're going to go over 50 or higher, you're looking at probably a VA loan, possibly an FHA loan, and maybe some other kind of non-conventional loan that's out there. So that is the DTI, debt to income ratio. Now, one lender, if you have very simple income and you're on a salary, you can do that math very easily yourself. If you have multiple streams of income, if you are on a variable income, like if you get paid hourly, those calculations are a little bit more difficult because we've got to go back and average the last 2 years. So that might be a little bit tougher for you to do. And every lender is going to look at those things a little bit differently. So if you're straightforward, pretty easy to do. If there's variable income, it can be a little bit more complicated. If you're self-employed, there's things that we can do as a lender to add certain expenses back in, and we'll come up with a different DTI ratio than you have. Okay. So if you have any questions on this, let me know. I'm going to leave it at that. I don't want to make this video too long. It's not that complicated. I'd be happy to help run your debt to income ratio, figure out what you can qualify for. Well, before I go, if you have that, let's take that $1,000 in monthly debt payments. Let's take the $10,000 a month in income. You roughly have about $4,000 more in usable income for a mortgage payment. So then what we do is we back into that number. What does $4,000 a month get us? What's going to be the sales price? How much are you putting down? What's the interest rate, taxes, insurance, mortgage insurance, HOA fees? So that all goes into figure out what you can qualify for buying a house. That's what we do every day. We love doing it. I love doing it. And I'd be happy to help you figure that out. All right, guys, have a good one. Until the next time.